Okay, welcome to Chapter 5. Here we're going to concentrate on cost behavior and cost volume profit analysis. I have to tell you that in this entire course, this chapter is probably the single most important chapter you will cover in this book. There are two other chapters that come close, but for my thinking as a former CEO and manager, I relied more on the information I learned out of this chapter than in any other chapter out of any other textbook I had in my entire MBA program. The reason for that is that in this chapter we're going to answer such questions as what price do I need to charge for my product and how many units do I have to sell in order to break even and cover my costs. But since most of us breaking even is not enough, we're going to look at, okay, I want to make X amount a year. How many units do I have to sell with this pricing structure and this cost structure? Therefore, this chapter is going to be, to me, is the heartbeat of any business that you're running. And again, it all goes back. We've kind of laying the foundation for it in the first couple of chapters. We talked about the cost terms in Chapter 1. We've looked at how to calculate our product costs in Chapters 2 and 3. Chapter 4, we kind of deviated a little bit and looked at the overhead rates. And now in Chapter 5, we're getting down to where we are looking at making the types of decisions that are going to be critical for the survival of our business. So, if we move to slide 7, you'll see that our fixed costs are those that remain unchanged. Again, this is by way of review. We talked a little bit about this in Chapter 1. Total fixed costs remain unchanged when the activity changes. Most of you have a cell phone that has, you pay a flat fee per month. Well, it doesn't matter if you're on this type of plan. It doesn't matter if you made one phone call or 100 phone calls, your total fixed costs are still the same. If we move on then to looking at the fixed cost though, on a per unit basis, our fixed costs will change as the number of phone calls goes up or down if we continue with that example. So that's a fixed cost. Let's look at the variable cost going to slide 9. And here, let's assume we're on a phone plan that we're charged per call. A lot of the earlier cell phone plans used to be like this. And so if we made no calls, we have no bill. If we made 100 calls, our cost would go up on a cost per call basis. So our total long distance bill change as the number of phone calls change. And if we move to slide 10, you'll see that our cost per unit, though, stays the same. And it's the same whether it's a cell phone or gasoline. For example, if you load up your car with gasoline, here in San Diego, the price per gallon right now is approaching $3.40 per gallon. So my cost per gallon is going to stay the same at $3.40. My total gasoline bill is going to be determined by the number of gallons that I bought. If I bought 1 gallon, I'm going to pay $3.40. If I bought 10 gallons, I'm going to pay $34, and so forth. So let's go to a summary table that compares these two, and here we have variable costs change as the activity level changes, but are constant on a per unit basis. Fixed costs, on the other hand, stay the same in total when activity levels change, but on a per unit basis they change related to volume. This is a slide that you want to keep handy especially as you struggle with figuring out whether something is a variable cost or a fixed cost. In addition, we mentioned earlier, we have the mixed costs, and I used the utility example in one of the previous chapters, and that is that the utility cost, you have a fixed portion and a variable portion. There's another variation in slide 13, which is a step cost. And in slide 13, the step cost is not truly variable, but it goes up in step format. And in this one, you think of a hospital with the number of nurses and the patients. Typically, you don't bring in one nurse for each new patient. That would be a totally variable cost. What you more usually find is that if you have from 1 to 5 patients, you'll have one nurse. As soon as you go from 6 to 10 patients, you would add a second nurse. That would be a stepwise variable cost. Now, if we move to slide 14, our goal in order to come up with making costs useful for us to make management decisions, our objective is we're going to classify all of our costs as either variable or fixed. And if there are 3 ways that we can do this and look at this, if we go to slide 15, you'll see we have a scatter diagram where we just we plot all our points, our different units of activity produced and our total costs, and we just visually fit a line. Easy to use, probably the least accurate. If we go to slide 16, the second is called the high-low method, where we take our high activity level and our lowest activity level, and again, keeping in mind our definitional parameters. Here we had 17,500 units as the low point, 67,500 units as the high point. The change was 50,000. Well, we know that fixed costs stay the same regardless of the level of activity. So therefore, all of that change in cost between the high unit level and the low unit level had to be attributable to variable costs. And if we go to the next slide, then we can see we divide that 8,500 by the 50,000 and we get 17 cents a unit, and we can see then we can calculate our fixed costs in this example would be $17,525. Okay. The third and the most accurate is least squares regression, or just commonly referred to as regression analysis. And here this requires an Excel spreadsheet or an Excel type calculation or some type of software package. The advantage of the least squares is that it takes into account all of the points. The difficulty with the scatter diagram is it's an eyeball method. We're just estimating and we're just fitting a line, so it's not very accurate. The difficulty with the high-low method is we only pick 2 points. We pick the highest and the lowest. Well, statistically speaking, those are typically the outliers. So we're taking and basing all our decisions on the highest point and the lowest point as opposed to looking at the ones in the middle. Least squares or regression solves this through a series of mathematical formulas built into Excel. The regression takes into account all of the data points, therefore providing you the most accurate method for calculating your fixed and variable costs. Okay, so now that we've done this, now we're getting to the point where how do we use this? So what? Who cares whether it's variable or fixed? Well, we're going to use this now in order to calculate our break-even point because at this, now we're getting to the guts of our business. We're getting to what is the most meaningful for you in your business operation. So if we go to slide 20, what we'll see in slide 20 is that we have our revenue, and we're going to take now and deduct all our variable costs, and we're going to get a new calculation called contribution margin, and we can do that either in total or on a per unit basis. We then look at our fixed costs, and we have our net income in this example of $36,000. And our question then is, we're obviously profitable. We made $36,000, but what was our fixed cost? What was our break-even point? So if we move to the next slide, what we'll notice is, again, this is a repeat of the prior slide. We have $30 per unit contribution margin. If we flow through to the next slide, slide 22, the first question we want to know is how many units do we have to sell in order to cover our fixed costs, meaning that we break even. We go to the next slide, and now we actually see, if you back up one to slide, we actually see the calculation that we have our fixed cost of $24,000 divided by the $30 per unit says we break even at 800 units. Notice our company actually sold 2,000 units, so we're well above the break-even point. So we would have expected to be profitable, and certainly we were. We had a net income of $36,000. So if we go to slide 23, we'll see then we have two formulas that we can use. The first is the break-even point in units, which is our fixed cost divided by our unit contribution margin. If we go to slide 24, we can then see our break-even point in dollars, which is our fixed cost divided by the contribution margin ratio. The ratio is our unit contribution margin divided by the selling price. So if we now then go to slide 29, we can start now applying some, we can take this out another step beyond. Most of you, while we do need to know the break-even formula, for most businesses, this is not acceptable. We all want to be profitable. Well, if we want to calculate our target net income, or if we have a target for our net income, we can still use the same formulas, only we now take our fixed costs and we add the target income and we divide by the unit contribution margin to get the required unit sales, or we would do the fixed cost plus the target income to get to the contribution margin ratio. Now, having done this, then if we go to slide 32, there are several other concepts that you will hear referred to in the literature. One is the margin of safety. And what we're doing here is we're trying to figure out by how much can our sales drop and still be above break even. So the formula for that is we take in the numerator our expected sales minus the break-even sales in total dollars divided by the expected sales, and that gives us our percentage safety. And then finally, we look at the operating leverage on slide 36. And in slide 36, we see that our contribution margin divided by our pre-tax income gives us the operating leverage, which is a measure to the extent that how a percentage change in sales will affect our profitability. So here in Chapter 5, as you can see now, we've kind of brushed through this real quickly, so you're going to have to go back and spend a lot of time digesting all these points and making sure you understand them. But you can see here in Chapter 5 now that we've moved beyond the first 4 chapters where we were merely aggregating and collecting costs. Now we're putting these to a proper use, which is how do we know where we are in relation to our profitability and our break-even points.